Something massive just happened inside the American auto industry. Ford has dropped a bombshell that no one saw coming. Prices are falling across the board, dealerships are panicking, and automakers from Detroit to California are scrambling to make sense of what just unfolded. It's not a discount, it's a full-blown price earthquake shaking the entire US car market. What Ford just did has flipped the game on its head.
So let's talk technology and the new Escape. There's so much we could talk about. Sync, My Ford Touch, Active Park Assist, all the things that people love and expect actually from Ford today.
And the ripple effects could change how Americans buy cars forever. Now let's break down exactly what's going on, what Ford just did, why prices suddenly crashed, and why the entire US auto industry is now in full-blown panic mode. Ford just unleashed one of the biggest price drops in its modern history. We're talking massive cuts across several key models, especially in their F-150 lineup, the Escape, the Bronco Sport, and even some of their EVs like the Mustang Mach-E. These aren't small markdowns. Some dealers are slashing as much as $12,000 to $18,000 off MSRP just to get cars moving off lots. Reports from Michigan, Texas, and Florida show Ford dealerships sitting on inventory piles they simply can't move. And now, corporate Ford has authorized price cuts and incentives not seen since the Great Recession. So why the sudden fire sale? Ford's been watching its sales stagnate for months. Consumer confidence is falling. Interest rates are at decade highs. The average new car payment in the US is hovering near $750 to $1,000 a month. Buyers have hit a breaking point. They're simply refusing to buy new cars at inflated prices. Ford, seeing the writing on the wall, decided to break first. Instead of letting inventory rot and dealers bleed cash, Ford is taking the hit now, hoping to spark demand and undercut rivals like GM, Stellantis, and Toyota. But the deeper problem goes beyond just high prices. Ford has been struggling with reliability concerns, quality control issues, and slow rollout of new EV models. Many customers lost trust after recalls, tech glitches, and rising repair costs. Combine that with record insurance premiums and fuel prices, and suddenly buying a new Ford just doesn't make sense for the average American. The used car market, while softening, still offers better deals. So, Ford's new vehicles, especially higher trims, are simply sitting untouched. Washington has started to take notice. The White House and the Department of Commerce are quietly monitoring the situation, as Ford's price cuts could trigger a domino effect across the industry. If GM and Stellantis follow suit, it could send shockwaves through production forecasts, employment levels, and even stock markets. Government officials are reportedly worried that this price war could spiral into layoffs, plant slowdowns, and another industrial slump, right when the economy is already under pressure from record auto debt and high household costs. And make no mistake, Ford's move has set off alarms everywhere. Automakers across the US are panicking because this isn't just about Ford losing sales. It's about the entire business model collapsing. Automakers have relied on high margins, low production, and premium trims to stay profitable since 2020. But now, with inventory stacking up and consumers refusing $60,000 pickups or $50,000 SUVs, the illusion of endless demand has cracked. Ford's move exposes what everyone feared. Demand isn't just slowing, it's evaporating. Behind the scenes, factories are already scaling back. Parts suppliers are being told to pause shipments. Plants in Kentucky, Michigan, and Missouri are seeing reduced shifts. Ford's not alone. GM, Toyota, and Stellantis are quietly cutting output too. Why? Because there's no point building more cars if dealers can't sell the ones they already have. What was once a supply shortage is now turning into a demand crisis, and the speed of that reversal has automakers in disbelief. Meanwhile, American buyers are watching closely. Social media is flooded with posts of people waiting, holding off their purchases because they believe even bigger price drops are coming. The psychology has flipped. Last year, people rushed to buy before prices went higher. Now, they're waiting because prices are falling. The average buyer is no longer desperate. They're cautious, patient, and ready to bargain hard. Ford just gave them the upper hand. Dealerships, on the other hand, are caught in the crossfire. Many are furious at Ford for devaluing their inventory overnight. Vehicles they bought at high prices months ago are now worth thousands less. Floor plan financing costs are skyrocketing, and margins are being wiped out. Some dealers are even refusing new shipments, demanding Ford compensate for lost profits. It's chaos on the retail side, and that chaos is spreading fast. And here's the kicker. Ford's discounts are forcing everyone else to follow. GM, Ram, Nissan, and even Toyota dealers are starting to match or beat Ford's deals. And within weeks, analysts predict a full-blown price collapse across the new car market. Vehicles that once cost $70,000 could soon sell in the $40,000 range. It's not just a correction, it's a reckoning. The bubble of inflated car prices that built up over the last 4 years may finally be bursting. But this isn't the end. This is just the beginning. Ford's decision could rewrite the entire pricing structure of the U.S. auto industry. From consumer psychology to dealer operations and corporate profitability, everything is now in flux. The question everyone's asking, will this save Ford or destroy it? And how far will the crash go before the rest of the industry follows? As Ford's announcement spread, Wall Street went into overdrive. Analysts scrambled to update forecasts, and within hours, Ford's stock started swinging wildly. Some investors see this as a bold strategic reset, finally admitting the market's overheated and moving first before the bubble bursts completely. Others, though, see panic, a desperate attempt to salvage sales in a collapsing economy. Financial networks are calling it the Ford shockwave, because it's not just about one company's sales strategy, it's about a $1 trillion auto market suddenly realizing it might be sitting on a ticking time bomb. Institutional investors are already shifting positions. Auto loan-backed securities, those massive bundles of car loans traded on Wall Street, are flashing red. Defaults are climbing, repossessions are rising, and the fear is that these price cuts could devalue collateral across the entire sector. When new F-150s lose 20% of their sticker price overnight, lenders holding billions in auto loans feel the pain immediately. And here's where things get darker. America's total auto debt just crossed $1.6 trillion. Millions of buyers are already underwater on their car loans, owing more than their vehicles are worth. Ford's discounts could worsen that instantly. Imagine paying $70,000 for a truck last year, only to see it listed today for $49,000. That's a financial gut punch for everyday Americans, and it could trigger another wave of loan defaults. Credit unions and banks, already stressed from rising delinquencies, might be forced to tighten lending even further, making it harder for new buyers to qualify. Inside Ford, sources say this move wasn't made overnight. Executives have been debating for months whether to keep production steady and risk oversupply, or take the hit and spark a market reset. Ultimately, they chose survival over pride. The company is betting that if they take the pain now, they can dominate the recovery later, essentially forcing rivals to bleed even harder. It's an aggressive, high-stakes gamble straight out of the Detroit playbook. Crush your competition before the market crushes you. Ford's also reportedly rethinking its EV pricing strategy. The Mach-E and Lightning, once hyped as Tesla competitors, have been losing momentum fast. With Tesla and Chinese brands slashing EV prices globally, Ford's hand was forced. This discount war could be the last stand for traditional automakers in a market rapidly shifting toward affordability and electrification. But the political fallout is just beginning. Several members of Congress are already calling for hearings, arguing that Ford's price cuts could destabilize the U.S. manufacturing sector. Union leaders are furious, worried that falling prices could lead to production cuts and layoffs just months after hard-fought wage increases. The United Auto Workers, UAW, has already warned Ford not to use market conditions as an excuse to scale back jobs. Meanwhile, the White House faces a tough question. How do you protect American jobs while the industry itself triggers a self-made crash? Behind closed doors, there's even talk of potential government intervention, temporary incentives, loan support, or new stimulus programs to prevent widespread layoffs. It's eerily reminiscent of 2008, but this time it's not banks or housing, it's the auto industry. Out on the streets, the shift is already visible. Buyers are flocking to dealerships not to buy, but to watch prices fall. TikTok and YouTube are flooded with viral videos of customers tracking price drops in real time. One video from a Texas dealership shows an F-150 losing $14,000 in price within 10 days. This new wait-and-watch mentality is changing everything. Dealers can't create urgency anymore. Consumers are in control, and that's something automakers haven't seen in decades. Even used car buyers are holding off, expecting a chain reaction that'll bring down prices across the board. It's psychological warfare now, buyers versus the industry, and Ford just fired the first shot. Behind the glossy showrooms, tension is boiling. Some Ford dealers have already started quietly cutting staff and canceling expansion plans. Floor plan financing costs, those interest payments dealers make on unsold cars, are eating into every dollar of profit. Dealers who stocked up earlier in the year now face losses on every sale. Some are turning to aggressive marketing tactics. 0% APR for 84 months. Cashback deals, free maintenance for 2 years. Just to get buyers in the door. But every incentive digs the hole deeper. Independent dealers say Ford Corporate has offered little relief so far. Many feel betrayed, claiming they weren't warned about how deep these cuts would go. One Michigan dealer reportedly said, "Ford just nuked our profits overnight. And now the dominoes are falling." GM has already begun reviewing pricing strategies for Silverado and Sierra models. Ram dealers are being told to prepare for market realignment, a coded phrase that likely means discounts are coming. Even Tesla, long proud of its pricing independence, may need to respond if Ford's move erodes EV margins industry-wide. This is how a price war begins, and history shows once it starts, it's nearly impossible to stop. What's happening now isn't just a business story, it's a cultural turning point. The U.S. auto market, once the symbol of American strength, is unraveling under its own weight. Years of inflation, record loan rates, and unrealistic pricing have created a bubble that Ford just popped. Every truck, every SUV, every high-margin model that automakers built their profits on is now being questioned. Can they survive in a world where consumers won't pay luxury prices for everyday vehicles? Executives across Detroit are terrified, but no one wants to say it publicly. The traditional car ownership model might be breaking down. Between EV transitions, digital direct-to-consumer sales, and subscription-based mobility, the old dealership-driven system may no longer be sustainable. Ford's drastic move could be the first step in a complete restructuring of how cars are built, priced, and sold in America. And as this new reality unfolds, one question looms over the entire industry. Can Ford survive the chaos it just unleashed, or will this gamble be the spark that burns the entire U.S. auto market to the ground? Within days of Ford's announcement, the shock began spreading far beyond dealerships. Used car auction prices started tumbling. Vehicles that sold for $35,000 in August were now fetching barely $26,000. Lenders began tightening credit standards overnight. Some finance companies even halted new loans for select Ford models, fearing their resale values would collapse before the ink dried on the paperwork. The market, once overheated, is now in free fall. Across America, repo lots are filling up again. Borrowers who stretched their budgets for new trucks during the pandemic boom are now realizing their vehicles are worth far less than what they owe. Banks are scrambling to reassess risk exposure. It's a chilling echo of 2008, but instead of houses, it's cars that are dragging households underwater. And here's where the spiral accelerates. As prices fall, buyers freeze. Why rush to buy now when tomorrow's discount could be even bigger? This fear-driven paralysis is hitting every automaker, not just Ford. Showrooms that used to buzz with weekend traffic now sit quiet. Salespeople stand idle, watching customers browse but not buy. The longer this uncertainty lasts, the worse it gets, because a collapsing market feeds on itself. Consumer surveys already show trust in automakers is sinking fast. Many believe car companies lied about supply shortages to justify record prices during the pandemic years. Now that discounts are back, the narrative has flipped. Americans feel manipulated. The emotional bond between car buyers and the brands they grew up with, Ford, Chevy, Dodge, is starting to fracture. And when the auto industry shakes, the U.S. economy trembles. Automaking supports over 7 million American jobs directly and indirectly. Every factory slowdown, every dealership loss ripples through transport, steel, electronics, and finance. If Ford's discounts trigger wider price cuts across the board, analysts warn it could knock half a percentage point off GDP growth in the next quarter. Small towns built around auto plants are feeling it first. In Michigan, suppliers are cutting overtime hours. In Ohio, truck haulers are reporting fewer shipments. And in Missouri, one Ford plant has already moved to a 4-day production week. The slowdown is spreading quietly but relentlessly. Meanwhile, international automakers are watching this chaos with mixed emotions. Chinese brands, especially BYD and Geely, see opportunity. With Ford slashing prices, they can position their affordable hybrids and EVs as the smarter buy. Analysts say China could flood the U.S. market with aggressively priced imports once tariffs ease, pushing prices even lower. In Europe, automakers like Volkswagen and Stellantis are alarmed. They fear Ford's aggressive pricing will trigger copycat moves in global markets already struggling with thin profit margins. The global supply chain is fragile, and a U.S. price collapse could send shockwaves from Detroit to Berlin to Shanghai. Inside, the U.S. dealers are no longer hiding their anger. A coalition of Ford franchise owners is reportedly preparing a joint statement demanding corporate compensation for inventory devaluation. Some are even threatening lawsuits, claiming Ford's corporate-level discounts breached contractual terms. Tensions are boiling online. Internal dealership forums are filled with posts from furious managers calling the move corporate betrayal. One dealer wrote, "We stood by Ford during the chip shortage. Now they've hung us out to dry Ford leadership, meanwhile, insists the move is temporary and necessary to restore balance." But few believe that. Then comes the collateral damage, the used car market. Prices for 2 to 3-year-old vehicles are falling fast. Dealers who once thrived on inflated trade-in values are suddenly stuck with inventory they can't sell without taking massive losses. CarMax, AutoNation, and other used car giants are now facing write-downs on thousands of vehicles. The average used vehicle price dropped nearly 9% in a single month, the sharpest fall since 2009. Even luxury cars aren't immune. A year-old Ford F-150 Platinum that sold for $68,000 last winter? Now worth around $49,000. Buyers who financed that purchase are already thousands underwater. The bubble that everyone said wouldn't pop just did. Inside Ford headquarters, executives are watching the chaos unfold with cautious optimism. Their gamble isn't just about clearing inventory, it's about reshaping brand loyalty. Ford believes that once prices stabilize, millions of Americans priced out of the new car market will return. Their logic: take the hit now, rebuild trust, and dominate the rebound. But there's risk in that thinking. Brand loyalty isn't what it used to be. Consumers today are fluid. They'll switch brands for a better deal or tech feature. Ford's deep discounts may move cars in the short term, but if the company can't maintain quality, service, and innovation, those gains could vanish as fast as they appeared. Major news outlets are now treating the Ford crisis as front-page material. Pundits are debating whether this marks the great auto correction of the decade. Talk shows are filled with consumers sharing horror stories about losing thousands in car value overnight. YouTube and TikTok influencers are making viral content titled, "Never buy a new car again," and those videos are hitting millions of views. The narrative is clear. Ford might have lit the fuse, but the entire U.S. car market was already soaked in gasoline. The EV segment is also taking a massive hit. Ford's Lightning and Mach-E discounts forced Tesla, Rivian, and Lucid into uncomfortable territory. EV demand is already softening due to rising insurance costs, battery shortages, and grid anxiety. Now, with cheaper gas and falling prices on traditional vehicles, consumers are hesitating to jump into EVs at all. Analysts say this could delay America's EV transition by years. The government's push for mass electrification depends on stable consumer confidence, and Ford's bombshell just shattered that stability. Suppliers, too, are bracing for fallout. Component makers who supply everything from transmissions to digital dashboards are seeing reduced orders. Truck drivers hauling vehicles across the country are reporting idle weeks. The slowdown is so widespread that some logistics companies are temporarily cutting routes. For workers on the assembly lines, uncertainty is growing. Overtime shifts are disappearing. Contractors are being released quietly. Union reps are demanding answers, but management remains silent. For many blue-collar families who depend on auto jobs, this could be the start of another painful cycle of layoffs and pay cuts. Ford's move might have been the first domino, but no one knows how far the chain reaction will go. Will this price war spiral into a full-blown collapse? Or will it finally bring car prices back to reality after years of corporate greed? The truth lies somewhere in between. But the chaos Ford unleashed is rewriting the future of the U.S. auto industry in real time. As Wall Street, Washington, and Main Street all brace for what's next, one thing is clear. This isn't just a sale, it's a signal. A signal that America's car market, once unstoppable, is now standing at the edge of a cliff. The storm has officially hit Wall Street. Within weeks of Ford's massive discount campaign, the financial system tied to the auto industry started trembling. Banks, credit unions, and finance companies began freezing new lending programs.